Hello, this is Kirk Kinder from Picket Fence Financial. And this month, we're going to be talking about a question I'm getting quite a bit from clients and other people. Was the little downturn from August and September, was it just a normal correction, or was it the start of a bear market? And whenever people ask me that question, the first thing I say is, why don't you come back in a year and ask me, and I'll tell you exactly what it was. Because ultimately, nobody really knows what it is until after the fact. Hindsight is 2020. So what I'm going to do today is just kind of take a quick look and give you a little bit of perspective. And as always, we're going to try to keep this thing to 10 minutes, maybe 15 minutes tops, just so you can get some good information quickly. Now, the first thing to note, the S&P 500, the U.S. stock market, basically dropped about 12% from its highs from late August into early September, and it's been climbing back up the past couple of weeks, which is good. But the thing people need to remember is 10% market corrections are really pretty normal. In fact, I always tell people you like to see that every so often. I mean, maybe you don't like to see it, but I guess as an investor, you should want to see it, because what it means is that the market is basically advancing, correcting a little bit, advancing some more, correcting a little bit. That's what you want to see in the market. Whenever the markets go straight up, like they've been doing for a while, it usually can put a little bit of instability. I know that probably sounds counterintuitive, but if things are going so well that if things finally do turn a little bit, they tend to overcorrect. So these little 10% corrections, while they may scare people a little bit, they're really quite healthy. And they're really pretty good things to see if you're in a bull market. So what this chart shows you is essentially every 10% correction going back to 1957. Now, the ones highlighted in blue were full-out bear markets, but the shaded ones in gray were just the normal 10% correction. So you can see, even outside of the bear markets, there's lots of little gray shades there. So lots of normal corrections. It's not something that is unusual. Now, it is getting to be a little bit more unusual over the past 25 years as opposed to going all the way back to 1957. And I think part of that, too, stems from anytime the markets start to correct a little bit, the Federal Reserve jumps in, tries to stem any type of correction. Ultimately, I think that's a bad decision. As I've said before, if you let it go too long without any kind of normal correction, you end up with a bigger correction. But still, you can see even within the past 25 years, we've had quite a few 10% corrections. So don't think that what happened, don't automatically jump to the conclusion that what happened in August and September is the start of a bear market. It really might just be kind of a normal correction. And this chart kind of gives you an idea, hey, maybe it was a normal correction. So we've had a little bit of a bounce from a bottom. So you can see at the end of August, we had a big down, sharp turn to the south, little bit of a bounce up. And then right as we approached October, we retested the lows. So the S&P 500 retest was at the level of 1,867. The nice thing from this chart is it never actually went below the late August, early September lows. It got close to it, and now it's been moving back up. So a lot of people who are stock market technicians will tell you this is a pretty strong indicator that things are looking up. So we went back down to the lows. We did not violate the lows. We tested it and then moved up from there. That's usually a pretty strong indicator that what we experienced was just a minor correction, nothing to freak out about, and that we're kind of going to have that onwards and upwards movement from here. Okay, so I've given you the thumbs up. Hey, everything looks great. Just a normal little correction. Let's stay invested and go. But there are some things that kind of have me on edge, if you will. In a previous webinar, if you go to my website, you can find it there. But I kind of showed that even the recent highs in the market we were getting back in April and May, it was happening from fewer and fewer companies. So rather than having a lot of the companies in the S&P 500 leading in charge, it was being pulled up by fewer and fewer. Not usually a good sign. The thing that's kind of got me on alert is the decline in profit margins. So we've seen the profit margins for the S&P 500, the companies within that, decline at least 60 basis points just recently. Now, this chart kind of should let you be a little bit nervous that anytime we've seen profit margins start to decline at 60, cause for alarm. Now, a lot of people look at that and say, well, hey, the big reason we've had that drop, just like we did in 85, was energy companies. So with the price of oil dropping, energy companies have seen their profit margins drop considerably, and that's why the market overall, the S&P 500 overall, is seeing this net profit margin decline. Maybe that's a true statement. I don't know, but it's just something, it's another data point to kind of incorporate into your thinking. Another one that I've been talking about now really for a couple years is valuations. We have pretty poor valuations if you look at the US stock market. And the valuation metric I use the most is what's called the CAPE. CAPE, C-A-P-E, stands for cyclically adjusted price to earnings. This was kind of developed back by Benjamin Graham years ago, but really made famous recently by Bob Shiller, Nobel Prize winning economist. And what Shiller does is he takes the past 10 years of earnings, adjusts those for inflation, and compares that to the current price of the market. And what that does is it gives you a general idea of what you could expect as an investor over the next 10 years from the markets. It does nothing to tell you about the short-term moves of the market. Even Bob Shiller will admit that. But it does stand to give you a pretty decent idea of where your current valuations based on the CAPE are going to provide you a return going forward. So, based on the red line right now is the current CAPE. The blue line is the future 10-year return that's been earned by investors. And you can see that future returns over the 10-year period are pretty tightly correlated to what the CAPE is. So based on the current cyclically adjusted price to earnings, U.S. investors should expect no more than about 5% on an annualized basis over the next 10 years. That's pretty low for the stock market, but that's pretty much what that's what we should expect. This chart gives you another kind of look that stocks are still pricing. This is still based on that CAPE, but what I've talked about in the past, if you've listened to some of my webinars previously, I talk about secular trends. So you have periods in the market where point to point the market is flat, and then point to point the market goes up drastically. So that valuation you always hear about the market earning 9 or 10% per year is true, but what happens is you usually get that in short bunches. So for instance, if you go back and you look here at 1981 into 2000, the market had an annualized return of over 14%. Since 2000, we've been pretty flat. The market really hasn't done a whole heck of a lot over that period. And you can see this goes back to 1966 to 74, the market was flat. But from 1948 to 66, the market skyrocketed up, 37 to 48 flat, 1931 to 37, drastic move up. Same with the move up from 1926 to 1929, drastic move up. But lots of flat periods within there. And if you look at the valuations of the CAPE for the secular trends, you can start to see that, well, when the secular trend starts, either way, if it's a movement to the upside, you have a very low CAPE. So again, 82, we had a 7 times CAPE, 48, 9. 31, it was 6 times, and then in 26, it was 5 times. Single digit price to earnings based on the CAPE. Whereas at the peaks, when the secular bear markets start, you have pretty high valuations, 24, 33, 24, 44, and then right now we're at 26. So we're still pretty high valuation. So usually you don't see secular bull markets start with valuations at 26. Even at the bottom of the 2009 market, we were at 13 times earnings based on the CAPE. That's not too bad. That's a pretty decent valuation, but it really isn't one that you see the robust secular bull markets derive from. So we'll see. I'm not a big bull when you look at valuations of the U.S. market, but you never know. Nobody knows. Now, one area I do like over the longer term, but I'm kind of bearish on the short term, is the emerging markets. So here again, this is similar to the slide we showed a little bit ago with the S&P 500, showing the comparison of the CAPE versus future 10-year returns. So right now, based on where the CAPE is for emerging markets, and again, for those that don't know, emerging markets, they're countries that have markets that, just like it sounds, are emerging to more developed markets. So we're talking China, India, Russia, Eastern European, and South American countries. So right now, their CAPE value is really pretty low. It's right around 10. Again, you like to see single digits to really get those robust secular bull markets, but it's still 10's a pretty good valuation. And based on that, what we could expect from emerging markets over the ensuing 10 years would be returns close to 13%. Not too shabby. So I do think short term it's going to be kind of a mess, because with the dollar getting stronger, and if we do have any kind of recession, emerging markets are probably going to get hammered. So we could see even better valuations here. But even if you put your money into emerging markets now, walked away for 10 years, came back, you should see something in the terms of 12, 13% returns. Not bad. You might have to endure some short-term gyrations and movements to the downside, but point to point from that 10 years, I expect to see pretty good returns from emerging markets. I've shown this slide before. What this does is it compares the CAPE as well as the dividend yield in various countries. So you can see the US has a pretty high CAPE and a pretty low dividend yield relative to other countries. You have to get out there into some of the developed European countries, developed Pacific countries, and of course some emerging market countries before you get to lower CAPE values, things below 15, and then dividend yields above, say, 3%. But they're out there: Norway, Singapore, Finland, New Zealand, Australia, Germany, Thailand, China. They all look pretty decent. So I think over time, over a 10-year period, you should get a better reward as an investor for investing in those countries as opposed to the US. But who knows? And again, in the short term, anything goes. I also want to just take a second to talk about why I think we're in this economic malaise. The reason we're not seeing robust growth around the world, it just comes down to debt. I've been hyping on debt since 2007. Really, 2006, I started talking about it. And what this chart shows you is debt levels in 2000 at the beginning of that bear market, 2007, and then where we were at the end of 2014. So 2007 was clearly a debt-caused crisis. And worldwide, we had $57 trillion of debt. Total debt as a percentage of gross domestic product at that time was 269% worldwide. The US in particular at that time was over 300% debt to GDP. Well, since 2007, we've actually seen our debt levels go up as a percentage of GDP. It's gone from 269% to 286%. Now you look at the compound annual growth rate between 2007 and 2014. Well, it has slowed. The growth rate has slowed from 7.3% from 2007 and 2007 to 2014 to 5.3. Households have actually delevered a little bit, or at least they've slowed the amount of debt acceleration from 8.5% to 2.8. Corporate debt has remained pretty steady. Financial debt has actually slowed drastically from over 9% to just under 3%. But you can see government debt has exploded to the upside. So as the households and financial corporate debt has kind of slowed or started to delever a little bit. The government has stepped in and really ramped it up. So we're actually increasing our debt levels. And the problem is, when you get to these high levels of debt, you're just not going to get robust economic growth. If you want to read a good book on that, there's a book called This Time is Different by Rodoff and Reinhardt. And those folks, those two economists, kind of showed how excessive debt leads to things like slower growth and more volatility in markets because of the low growth. So we still, going back to looking at the price to earnings at high levels and at levels that usually are more synonymous with secular bear markets and not secular bull markets, I think it comes back to the debt levels too. We're not at debt levels where you're going to see robust growth. Now, again, that's kind of a generalized number. We looked at the world overall. There are some countries that are deleveraging or reducing their debt. So what this chart looks at is advanced countries or developed countries compared to the emerging or developing countries. And you can kind of see along the x-axis is the debt to GDP ratio. So again, the lower you have debt to GDP, the better. So the further along the left side of the chart, the X graph, the better. And then along the y-axis, we have the change in the debt to GDP from 2007 to 2014. So the higher up we go here, the more debt the country's been taking on relative to the size of its economy. So we can see Ireland, Singapore, Greece, Portugal have taken on massive amounts of debt relative to GDP. And the bad thing for those countries, they also have a high debt to GDP ratio. So if you look at China, its debt to GDP ratio along the x-axis, it's not good, but it's not horrible. But for them, what's been bad is they've been adding debt considerably since 2007. China used to be much lower in the debt to GDP ratio. But you still have some countries that are pretty reasonable. And the ones I really like are the ones with low debt to GDP, like Romania, Egypt, Saudi Arabia, Argentina, Israel. The other nice thing about those countries, not only do they have a lower debt to GDP ratio, but they're actually reducing the amount of debt they have compared to the size of their economy. So they're deleveraging. Even other countries or emerging ones, sort of, everything from about 120% debt to GDP or less, those countries, they have pretty good debt to GDP ratios, and they're not taking on a lot of extra debt. So I think over time, what you're going to find is those countries are going to be doing much better economically, and ultimately that's going to lead to better stock market returns. As you notice, most of those are developing countries. And I've just talked about a little bit earlier how emerging market countries or the developing countries really stand to provide investors with a better return over the ensuing 10 years if history holds. Much lower price to earnings, much lower debt to GDP. So with those factors, you can see that you're probably, despite the short-term fluctuations, going to be better off investing in those countries as far as getting a return. Those countries have been horrible performers over the past 5 years, but those past 5 years of underperformance have set them up for a nice overperformance in the ensuing decade. But again, I don't know what's going to happen in the short term. Nobody does. So that's just kind of a quick rundown. It could just be a normal correction we experienced with the recent volatility in the markets. You could certainly make the strong case that that is, in fact, what happened. But I think you can look at some longer-term trends with profit margins and valuations. Yeah, we could be in for a little bit of a rougher ride. But again, if you want to know exactly, come back and ask me in a year, and I'll tell you if it was a bear market or not. So thanks for listening today. And I do want to let you know that if you want to get my monthly newsletters, which would include links to all of my webinars, you can go to picketfencefinancial.com/education and sign up for the newsletter there. You can also go to our Facebook page or go to my YouTube page. And I guess what you call the Twitter handle is just Kirk Kinder. So thanks for listening. And if you have any questions, please let me know.